On Dukascopy TV, we let you know what's moving and shaking in the currency markets. But today we're going to take an in-depth look at options trading. I'm joined down the line by Stephen Place, founder of investingwithoptions.com, to explain the risks and rewards in trading options. Mr. Place, thank you for joining me. Can you give the viewers an overview of trading options and how trading options compares to other instruments such as Forex and stocks?
Sure. When you have Forex or futures or commodities or stocks, you care about pretty much one thing. You care whether it's going up or down, long or short, right? With options, you not only care about whether the underlying is going up or down, you also care about how fast is it going to move and how long is it going to take to get to a certain price. So, there's certain kinds of risks in the market, and we can't predict the market, but we can assign probabilities. And that's where that how fast and how long part comes in. And so if you can figure out the direction of the stock, and if you can figure out whether the pricing of the option is overvalued or undervalued, that's where your edge is in options trading.
I see. And what kind of return on investment do you get when trading options? What kind of startup capital do you need?
This is going to vary from person to person, and obviously it's going to be a function of risk and reward. If you want more rewards when trading options, you're going to have to take much more risks. I would say a good goal for starting investors, first off, is to get to break even. Learn how to not lose money first, and then you can learn how to make money. But a good goal is 3 to 5% a month, okay? And you can do that using fairly conservative trading strategies such as covered calls or income-based trades like iron condors. In terms of startup capital, with smaller accounts, you're going to be at a natural disadvantage just from the commission structure and the slippage and the inability to day trade, but you can still successfully trade options conservatively with, as low as, I'd say, $5,000. But it becomes much easier once you get into the mid-five figures.
And many consider options trading risky business. How do you minimize this risk when trading options?
There's more risks because we deal with different pricings. Like I said earlier, Forex and commodities and futures, we care about up or down. So the risk is up or down, okay? Now, there are other things that affect the pricing of an option, okay? And these risks are known as the Greeks, okay? So you have the up-down risk that you're used to in directional trading, but you also have, if you buy an option and the underlying does not move that fast, you have time decay, which is known as theta, okay? So that's a big risk. If you're short an option, okay, and the underlying moves way too fast against you, then that's the short gamma risk, okay? So these are kind of advanced terms, but ways to minimize risk is to, first off, understand the risks that you're taking, okay? And I would say for beginning option traders to focus on spreads, which are limited risk, limited reward, and the Greeks, the risks associated with the Greeks are much more tame compared to straight up long options or straight up short options.
What specific company options are currently on your radar and why?
I'm watching because of the parabolic move higher in the financials related to the Federal Reserve and the European bond buying that we saw, the reaction to that news last week. I'm looking for these names to consolidate, okay? So I don't really care which way it goes, okay? I'm not long biased or short biased. I'm actually neutral on direction. So, for example, in Goldman Sachs, it's trading around 114 2/3 right now. It was trading 7 points lower just 3 days ago. So a very strong parabolic move higher. I don't think there's that much upside left in the stock in the near term, okay? And I don't think that, we're going to break underneath 107 anytime soon. I think we're going to be range bound for a little while, okay? Now, to structure this risk, I'm looking at, it is an October, January 115 call calendar. Now, there's a lot of stuff going on there, and it seems a little complex, but this is a trade where you make money as long as Goldman Sachs stays above 107 and below 122, for about the next 20 days, 20 calendar days. And so if that works out, if we stay range bound, then it's going to end up being a profitable strategy. If I'm wrong and the underlying moves much, much more either to the upside or downside than what I was expecting, that's where my risk is.
And lastly, what advice can you offer traders wanting to get into options trading at this time?
It can seem overwhelming at first. It can seem very, very complicated at first. But once you understand the basics, learn how to visualize the trades. If you can visualize the risks, and you can use this through options analytics software and so on, if you can visualize the risks, then it becomes much more understandable. On top of that, if you learn how to trade with a volatility mindset, that's going to give you an edge over a lot of other option traders out there who are just using options for simple up-down ideas and only using options for leverage. You can effectively trade against them and get an edge from that.
Thank you, Mr. Place, for your opinions and insights into this exciting form of trading, and hopefully our viewers will be able to take your advice on board and reap some success in the markets. Thanks for watching and good luck trading.